Thank you, Chairman Adolph, and good morning. My first question is for PSERS. The assets under management by PSERS are less than what they were in 2006. $49 billion in 2013, approximately $57 billion in 2006. Investment management fees are more than 2.5 times higher now, $557 million versus $211 million. During that same period, the CSERS investment expenses declined by 35%. Can you explain what's going on with the fees to be that much higher?
Sure. We hire active managers over time, and we look to exceed what we can get from what we call low-cost passive benchmarks. So an S&P 500 index, a Barclays high yield index. We're continually looking to gain alpha from our managers. So last year, I think our fees were up $77 million from the year before, and the excess returns that those managers generated last year increased by $287 million. So even though the fees increased, the excess returns that we're generating have increased as well. And we look at it, for each dollar in investment expenses, we get back about $2.83 in incremental return. So we're able to generate incremental return from active management.
Thank you. My second question will be for CSERS. In the letter that was included in the comprehensive annual financial report that was authored by Mr. Anthony Clark, CSERS Chief Investment Officer, to quote it, he wrote, "Investment diversification is a primary approach used to achieve return objectives with minimal acceptable risk." So that's his quote. My question is, what is the minimal acceptable risk? How do you define it? How's it quantified? And how do you measure it?
I'll take a stab at answering that question. The minimal acceptable risk is in a comparison to determine whether or not that asset class has a reasonable chance of achieving its objectives, and that you will attain those objectives with a reasonable chance of not losing them as well. It's a balancing act by asset class. When you look at each one, you make a determination, are we going to go with a particular weighting in a particular category? And if we do that, what are the opportunities for us to gain funds? What are the opportunities for us to lose funds if the market goes the other way? And you do that asset by asset class. So it's an assessment that the professionals make regarding the gains that are possible and the losses that are also possible, and structuring the portfolio around that.
Now, how do you measure that you're actually achieving what your objective was?
Each asset class itself is monitored and measured against a series of benchmarks. Those benchmarks are industry standards. They're selected to match up against our particular portfolio in our particular circumstance. As Representative Godshall correctly points out, we are a mature plan. We have more annuitants than we have active members. It's not a problem for us yet because we've been planning for that for some time. So we have adequate resources to pay the benefits. What he's also correct about is we have to make sure that we have the liquidity that we need. Therefore, we will look at our asset classes slightly differently, so that we can make sure that we can make those payments every single month. So when we look at that, we have to monitor our performance against the benchmarks, and each asset class has its own series of benchmarks that we use.
So, and because you're paying out to more members than really expected at this point, and because of that, you're having to turn a lot of your assets into liquid assets.
We have to be more balanced in that approach to make sure that our liquidity needs are being met. That means that we may not be weighted as heavily in certain markets where the return could be great, but the risk of underperformance is too great as well.
But how long, with the current unfunded mandates, how long can you sustain that liquidity with your assets to make those payouts? And how is that going to affect the future of that fund with the long-term investments that are needed to sustain the retirement systems?
And it's an excellent question. What we've done is we're beginning to move ourselves away from a model that we had before. The strategic plan has, over a 10-year period, movements in every single asset class to take advantage of those markets and balance the risk appropriately. In addition to that, we're cash flow positive, and we have been for the last 2 years. In fact, the fund added $1 billion in real dollars this year. So despite the fact that we do have and need to plan well to meet our annuity payroll. We are repositioning assets to do that, and with the Act 120 collars, increasing the employer contributions and the performance of the fund to date, we're actually increasing our values. So we feel pretty good about our position right now.
So if we reduce the collars, though, I don't think you're going to feel as good about your position.
Well, any deferral of the payments creates a need to make up those payments. It's just like a credit card. If you make the minimum payment, you will eventually pay off your debt. If you make less than the minimum payment, your debt increases over time. So our presumption, our projections right now are based on what Act 120 is. That's the law. And we believe that as long as we can hit those targets and we can hit the 7.5, we will grow the fund.
And just to be clear for everybody watching this, the governor's proposing that we reduce the collars that are current law, that we're required to actually invest in the pension plan to make them sustainable for the future.
It's our understanding that that increase that would take us to 20.5, it's been recommended that that increase go only to 18.25. That's correct.
Thank you. Thank you, Mr. Chairman.